Thank you, Sonia. Thank you, everyone. As we come into the last hour now of our morning trying to address some of these big issues, we're going to turn, as we have in years before, to Larry Summers, former Treasury Secretary, leader in education, Harvard professor, and as you'll know, a man with an uncanny ability to give us a sense of where we're going. We are, of course, trying to chart the longer-term trends today, looking at what's happening not just in the next 6 months, 12 months, but over the course of the 2020s. I'm very struck by the fact, of course, that we do so at a time where interest rate decisions, the pronouncements of the Fed chairman, these things are roiling markets and making us rethink our decisions in the very short term. So I'm hoping that what we can do in a conversation with Larry is try to, if you like, bridge the two, to try and get a sense of how we make sense of the decision the Fed made yesterday, the one the Bank of England is making today, and how we understand that those short-term realities, those short-term questions, with a view to the longer-term issues that we've hopefully framed successfully in thinking about growth, and growth in a world that is fragmented within countries and between continents. Ladies and gentlemen, please join. We're going to be joined by Larry Summers. Larry, thank you so much for doing this. Can you hear us okay?
Yeah, I can't quite hear you.
Okay, well, I don't know whether that means I shout louder or just keep talking.
How's that? Let's try again.
I can hear you perfectly. We can all hear and see you. Can you hear us?
Now we can, yes.
Larry, thank you so much for doing this. We really, really appreciate it, particularly because it's quite early where you are. Larry, listen, could we start? I think we had some plan for looking at the longer term, but given what the Fed Chairman Jay Powell said last night, I wonder whether we could start there and whether you would give us an interpretation of what he meant. He seemed to signal higher rates than expected over a longer period of time, and I wondered what you thought that meant. North of 5%, what kind of period of time? What do you think the Fed is now aiming towards?
I thought that Chairman Powell did a very good job in his press conference. I did not think the drafting of the statement was ideal, but that doesn't really matter now since it was modified during the press conference. I think the Fed's objective above all else was to signal that it was remaining resolute with respect to inflation, to recognize that we'd gotten data that was not so good on inflation since their September meeting, that we had gotten data on how tight the labor market was remaining in terms of a very high level of vacancies, that we had continuing concerns that we would see more inflation in the figures that would come out over the next few weeks, and to push back on any idea that the Fed thought they were finished and had raised rates enough. At the same time, I think he was attentive to the fact that there were some concerns about financial instability in the light of what had happened in Britain and some of the concerns about liquidity in the United States, and that it was a highly uncertain environment, and it was better not to push rates up too fast because that would make it hard for them to come down. So he signaled that his expectation was that we'd need to end with higher rates than he had previously thought, but that there was probably more uncertainty than he had previously thought. Markets are now pricing in that the peak of the Fed funds rate will be in the 5.10 or 5.15 range. My best guess is that it will be somewhat higher than that before this is finished, because I think that we've got a very tight labor market, and that's a very important factor that is going to shape inflation expectations. But I think it was a broadly successful and appropriate effort for the Fed.
Larry, can I just press you on that? We spoke a few weeks ago, and at the time, market expectations were just north of 4%. And when I asked you, you said, well, I think it'll go higher than 5%. When you say higher than this current market set of expectations, how high do you mean? Do you mean higher than 6%?
I'm sorry, the market is now predicting a peak rate of 5.10.
Yes.
And I would expect that it will go higher than that.
And so how much significantly higher do you think?
I would probably say the odds are 70% that it will get to greater than 510. My best guess would probably be 550. Six would not amaze me.
And then you talked about the tight labor market, Larry. One of the issues in all of this has been the point I think you've made repeatedly, certainly on TV in the US, has been the US is going to need to get its head around the fact that unemployment is going to need to rise, or is going to rise. What's your expectation there? Unemployment rate will rise to kind of what level do you think it's going to peak at?
Look, I want to be absolutely clear that increases in unemployment are terrible things, that no one wants to see increases in unemployment. What is suggested by historical experience is that usually when you do sufficiently restrictive policy that bring down inflation substantially, that unemployment as a side effect of that increases. And that if you don't do that, you don't avoid an increase in unemployment, you defer the increase in unemployment, and you ultimately have a larger increase in unemployment. That's why we had an unemployment rate of 10.8% at one point in 1982. I don't know where we're likely to be, but I would think that unemployment was likely to exceed 5% and quite possibly approach 6% in the context of this, unless we are very successful in a set of supply side policies, unless team transitory turns out to be right. And I would recognize that my views are probably more pessimistic than the consensus views. Now, my views have been more pessimistic than the consensus on inflation for a long time. And unfortunately, I've been right. But I would be the first to recognize that there's a spectrum of opinion here.
Are you changing, just on the transitory point, Larry, are you changing your view on that? Do you see signs that some of the inflationary pressures are more transitory than you thought?
No, I don't think, I can't say honestly that I do. I think the question you have to ask is how much inflation is monetary policy going to have to push out of the system? And how much inflation, in a sense, reflects one-off price increases that's going to fix itself? And I think my judgment for quite some time has been that it's on the order of half and half, that if inflation is running in the 7% range, that 2.5% to 3% is probably going to have to be pushed out with monetary policy. And the other 2.5% is things like developments in the housing market, where we are starting to see relatively strong evidence of a turn.
Larry, what do you make of the implications? Early in the day, Roberto Campos, the central bank governor of Brazil, was here. In fact, we started to talk a little bit about the impacts of a strong dollar, inflationary pressures, rising interest rates on economies around the world. Give us your read on what a persistent period of dollar strength and rising interest rates are going to mean.
Well, I'll be curious for you to give me a 3-sentence summary of what the Brazilian central bank governor said, so I can compare my reaction to his from the front lines. Look, I don't think there's anything good about it from the point of view of the rest of the world, except for the fact that if you don't have it happen, it's going to happen in a stronger, more painful form a year or two down the road. I don't think it serves any other country for the United States to turn itself into an entrenched, moderately high inflation country. I think the difficulty comes in the fact that higher interest rates and a stronger dollar come at a time when countries are already reeling a bit from the fact that their export markets to Europe, the United States, and China are all slowing, reeling from the strains that we're all dealing with from the aftermath of COVID, and in many cases, the rise in oil and food prices is a particularly serious kind of particularly serious kind of problem. And so all of those are issues. I think that we have not seen enough effort yet to address for some of the poorest countries challenge of debt restructuring and debt recycling. And I think we have not seen for some of the middle income countries sufficient energy in terms of providing rapid standby finance from the international financial institutions. On the other hand, James, I think it's also important, and it's very easy at moments like this to get all pessimistic. Mm-hmm. And I think it's also important to recognize that many more countries have borrowed in their own currency. Many more countries have flexible exchange rates, which they're not trying to defend. And many more countries have a large quantum of reserves. I mean, I'm not sure exactly what the level of reserves are in Brazil, but it's really in a different kind of range than it was when Brazil was trying to defend a peg, ultimately unsuccessfully in the 1990s, or when Brazil required a debt restructuring in the 1980s.
I guess the point is that it feels as though we're living in an age where there's nothing surprising about surprises. And I wonder whether or not when you just stand back and you look at a strong dollar and you look at some of the economies that look more vulnerable to it, what you'll read is either a particular asset classes or particular economies that we should just keep an eye on.
I think I'm going to duck that one by saying that, as somebody put it, when the road is very icy and the sky is very foggy, you may not be able to predict which cars are going to have accidents, but you can predict that there'll be an elevated accident rate. And I think that would be the kind of view that I'd want to take from a financial point of view here.
All right. Well, then let's turn to, if you like, a more positive aspect of things. One of the aims in the conversation today has been not just to sort of comment on the realities of a fragmenting world, but try and find the path to growth. And of course, at least from what I've read, you were very heavily involved in the Biden program, or at least behind the scenes on the Inflation Reduction Act. Commissioner Johannes Hahn was here talking about the next generation EU investment program. And on both sides of the Atlantic, we have seen really colossal moves by the government to make investments in strategic industries, in combating climate change, but also in helping our economies to recover. I just wondered, from a global point of view, what you think that's going to mean to the way in which governments think about their responsibilities to growth and their expectations of the private sector to row in behind those plans.
guess I would make three comments. The first is that I think with a lot of problems and with a lot of uncertainty, I think we're moving beyond some sterile debates about the invisible hand versus the heavy hand to a set of concerns about a helping hand from government. And I think the nature of the energy problem in particular, and perhaps also the resilience challenge, is going to lead to more public-private sector cooperation than we have seen. Second, I think there's been a sea change in thinking about climate change over the last 5 to 10 years. I think that on the one hand, the political resistance to higher energy prices and to carbon taxes and the like in most parts of the world has proven to be even stronger than one might have thought 5 to 10 years ago. On the other hand, I think the scale of the economic opportunity that is available in creating low-priced energy, usually low-priced electricity, and then electrification of functions that didn't used to be electrified, to compete on very attractive terms with fossil fuels. I think that has gotten substantially more attractive than one might have expected several years ago. So I think there's going to be an immense opportunity for those pushing the frontiers of the technology, but large amounts of economic activity that's in a sense auxiliary to that, whether it's working out financial deals around new infrastructure, whether it's locating everything that needs to be located around the places that are going to be hubs of that new activity, whether it's making use of the byproducts of those kinds of chemical processes. I think there's going to be immense opportunity that's going to be created as this takes place. And for those with creativity, I think it's going to be there. I think the prospects are greater now for reasons, some good, some bad, that after this current episode of high inflation and need to contain the inflation, I think it's less likely that we will return to an era of secular stagnation than I did previously. The combination of strong fiscal policy impetus, which pushes towards more demand and higher interest rates, and impetus to private investment from climate change and resilience investment makes a difference. I think that ultimately we are going to find our way to better work business relations than we had earlier. I suspect that in ways that will differ from sector to sector, we will find ourselves with substantial going back to work relative to what has been the norm for the past year. But I suspect we will never quite find ourselves all the way back to the road warrior culture, either for people like you and me being on airplanes every other day, or for many working people who have commuted 4 or 5 days a week, long distances. And I think that's going to change in important ways the way people live. And I suspect that there'll be some shaking out But I think ultimately it will end up for the better.
Larry, I'm massively encouraged to hear you say that. I'm hugely encouraged. In the last minute or so that we've got, I know that you've sometimes done these long, short, quick-fire questions, and so I hope you won't mind if I ask you, 10 a dozen or so. Do you go long, do you go short? The risk, of course, is that we come away thinking we've taken some massively complicated issues and oversimplified them, but I think we might get some illumination too.
Okay, here goes.
Okay, here we go. So, are you long or short? I think the S&P 500 closed at about 3,800. US equities, long or short?
Short.
Whoa. Oil price, Brent crude was, I think, closed about $96 last night. Oil price, long or short?
I'm answering these questions with a 6-month horizon, because I don't know at any horizon, but I certainly don't know at a 2-day horizon. Long.
Wow. Okay. The euro is, I think, about there's $1.03 to the euro, pound 13. The dollar, long or short?
I'm sorry. Did you ask me about the euro or the pound?
The dollar. Ask you about the dollar. Dollar, euro, dollar sterling.
I'm long against the pound, flat against the euro.
Long against the pound, flat against the euro.
Correct.
Okay, thank you for that. All right, we're going to get a little more philosophical, if you don't mind.
We're going to make a rule. We're going to make a rule here, which is that if I ever do an interview with you again, you're not allowed to have remembered what I said.
Okay, fine. I think we're getting to know each other. There's no risk of that. Okay, Larry, we're going to get a little more philosophical. Lula's Brazil, long or short?
Long.
Oh, Elon Musk.
Long in part because there's not a lot of places to go up from a pretty deep valley, and Brazil's got enormous economic potential and energy. It's kind of the United States of Latin America, and it's a mistake to bet against ultimate dynamism.
All right. Elon Musk's Twitter.
I'd buy a straddle. I'm long the volatility. Twitter.
All right, not that I'm making an equivalence here, but Xi Jinping's China.
Short. We saw today, a statistic came out in the last few days. China now has negative population growth. It has massive capital flight. It doesn't have a good exit strategy from COVID. And that's before you get to the biggest real estate finance crisis in the history of man or any of the political complexities.
All right, and then here are your final 5, quick fire, long or short. The metaverse?
Short.
Banking stocks?
Long.
The IMF?
Short.
Tom Brady?
Short.
Donald Trump's prospects for the Republican nomination?
Short.
Larry Summers, thank you very much indeed.
Thank you.
Thank you, Larry.
Thanks.
And it's my pleasure to hand over.